Good evening.
Hello.
Good evening.
Good evening, sir.
How are you?
I was really struggling with logging in. At first I entered, there was no one. Later on, it was showing me the session has ended. Then I'm back.
Now you're back finally.
Yeah,
That's
I've
fine, eh?
succeeded.
Okay, I want to welcome you to the second session. Yesterday was our first session of Financial Accounting 2. Actually, the session went on right. We introduced from from the introduction, and the introduction was more of looking at the course outline, then introducing our first topic. And our first topic was partnership accounting, as we introduced it yesterday. Okay, hope we are now moving together again. I was trying to to give a flashback of what we looked at yesterday. And the main area of concentration was the partnership accounting, whereby we saw what partnership is, the main features of partnership business. Yesterday we also looked at the different types of partners, forming a partnership business, that is a partnership agreement or deed. And we talked about the different contents within a deed, including the name of the partnership, the name of the partners, the profit and loss sharing ratio, capital contributed, interest on drawings, mode of settling disputes, keeping books of accounts, the rules and regulations of the rights and the duties of each and every partner, and so on. Then we went further and also looked at preparing the financial statements for the partnership, whereby we said the financial statements for the partnership almost look the same like those of sole traders. The only difference is going to be with the third section of the income statement. The income statement has 3 parts, but with the sole trader, you're going to find out the income statement has only 2 parts. It has the trading account, then the profit and loss account. When you reach the net profit, sole trader is okay, can share the profit. But I said with the partnership, a third section called appropriation account is supposed to be added on in order to give each partner what belongs to him or her. That's what we saw yesterday. We say the balance sheet of the partnership almost looks like the balance sheet of the sole traders. The only difference comes with the capital accounts and the current accounts, whereby we say the capital accounts are used to record the capital contributed by each partner. And if you are using a fixed method of maintaining capital accounts, then you are going to have current accounts. It's what we said yesterday. I also tried to illustrate yesterday how to come up with current accounts. We had it yesterday, that illustration we saw, and we said the current accounts record the day-to-day claims of partners within a partnership, and we say the debit side of the current account will record what a partnership demands a partner. In other words, it will record items that will reduce the claims of a partner from the partnership. Then the credit side of the partnership of the current account will always or records the items that increase the claims of a partner within a partnership. In other words, what a partner demands a partnership is recorded on the credit side of the current account. Those items we saw, even given the illustration as we tried to do them. Today, I want our main area of focus let us look at these terminologies anyway. Then after looking at the terminologies, we are going to look at preparing financial statements for the partnership now, practical. Because yesterday I showed you the format, I showed you how current accounts look like, but we did not go into the depth of calculating the real number. We want to do the calculations today to see how do I prepare financial statements for a partnership. Given the question papers, the questions as they were uploaded yesterday, I think you downloaded them and you have them. We are going to be moving a little fast, given we have said a little later and the time is not our best ally. These important terminologies, as we use them in capital accounts, in partnership accounting. For example, capital contribution, interest on capital. But let us move step by step and see what each means. Someone talks about capital contributions. Very direct. Capital contributed by each partner for the well-being of the partnership, to finance the operations of the partnership in order to realize the profit by the end of the year. That's what I mean by capital contributed. In most cases, when a partner brings capital, whereas we debit it in the cash account or in the bank account, we are going to credit it on to the capital account of that partner who has contributed it. Now, interest on capital is a reward that is given to a partner for foregoing consumption and preferring investment. In most cases, bringing capital into a business is a matter of sacrifice. So if a partner brings in a capital, you are supposed to reward such a partner with interest on the capital contributed. It's a reward on the capital. The reward for capital is always interest. Again, it is another way of encouraging partners to contribute more capital to a partnership, because the more capital that you bring, the more interest that you are going to take back at the end of the day. Now, interest on drawings. But before we talk about interest on drawings, what are drawings? But I want to imagine from accounting, when we are very much conversant with such a terminology, interest on drawings is going to be that charge that we put on the amount withdrawn by a partner from the partnership for personal benefit. Just imagine a partnership of A and B, and A, as a result of a personal need, withdraws 1 million from the partnership business. The only thing that we do is, as that partner is bringing back 1 million, must attach interest, as the partners may agree. So, again, charging interest is another way of discouraging partners from withdrawing resources from the partnership, because they fear bringing back money with interest. So we want the partnership to remain with this money so that we don't run bankrupt as a result of some partners taking money for their personal needs. Then interest on credit current account balances. When I was preparing a current account yesterday for you, I told you a current account must have a credit balance. A credit balance is a normal balance. A credit balance means the partner has not withdrawn resources from the partnership, but instead has left them into a partnership for the well-being, betterment, and the prosperity of the partnership business. However, some partners withdraw these resources completely. Fine, they may be their resources, but for the good of the partnership, it doesn't mean that whichever belongs to you are supposed to pull it out from the business. How will the business expand? In other words, for example, if there is a share of profit, and instead of taking the profit, you plow it back, you are causing the partnership to expand. But some partners take. So the interest on credit account balance is going to be that reward that we give to partners who are so much patient. They don't withdraw resources. However much they belong to them. They try to sacrifice and leave them to a partnership and pave way for the partnership to expand. such is going to be interest and give. In the same way, sometimes the partners penalize partners who over withdraw resources from the partnership and have debit account balances. You find some partners, as they agree upon it in the deed, they penalize such partners. If you can see it here, the interest on debit account balances. Whereas interest on debit account balance is debited to the current accounts of the partnership, of the partner, then interest on the credit account balance is credited because it is a reward to the partner. Now, it is time for preparing financial statements. I want to imagine how my students are very ready, actually very inquisitive to see how partners prepare financial statements, because the theory that we have gone through, the formats that I've showed you, really show a partner can prepare good financial statements, share each and everything as agreed in the deed, and we avoid disputes. Let me take you to the question paper. Look at that. Look at the question paper there. Mawanda and Mulwana are in partnership sharing profits and losses equally. Their trial balance as at 31st June 2007 is as follows. Buildings, fixtures, provision for depreciation, the figures you can see. Provision for depreciation, fixtures, trade receivables, trade payables, cash at bank, inventory, sales, purchases, carriage outwards, discount allowed, loan interest, office expenses, salaries and wages, bad debts, provision for bad debts, loan from Junju, Capital, Mawanda, Mulwana, current accounts, Mawanda, Mulwana, drawings, as you can see. That is a question. Required. Prepare partnership income statement, profit and loss appropriation account as at 30th June 2007 and balance sheet as at that date. This question, however, has additional information as we can see it down here. This additional information is very important if you are to prepare financial statements. Interest on capital account balance 10%. Interest on drawings Mawanda 1,440,000, Mulwana 960. Partnership salary 6,400,000 to Mawanda, but not yet entered. Reduce provision for budgets to 2,560,000. Depreciate fixtures 10% per annum, reducing balance basis. Buildings 8 million. Expenses to be accrued. Office 768,000, wages 1,600,000. Event on the 30th June 2007, shillings 450,720,000. That is the inventory. Now we are required to prepare financial statements. That is very encouraging. Let us go to our Excel sheet. You know, when we were doing these numbers, we're supposed to take away emotions, cool down, take away pressure. Things just work out very simple, in a very simple way. Don't complicate anything. I just beg that you get a calculator. Just a calculator. Then we do move on. Simply. Just pick a calculator. Just pick a calculator. Then we follow these steps. They are not hard steps. They're just two simple steps, as we are going to see down here. I just hope we are at the same footings. Can you see the Excel spreadsheet this time? Or you cannot? Because yesterday the issue of Excel display was a little problematic. But hopefully today things have changed. And you see this Excel worksheet?
Yeah, I can see everything.
You can see everything.
It's clear.
I'm trying to analyze something here.
Thank you.
Okay, we are there. Go through the question as I'm also trying to organize something very small here. Please go through the question. Such that we prepare financial statements together and we are all at the same footing. Is that time as I'm organizing my Excel spreadsheet, you're supposed to use it to look into the question, internalize each and everything, such that finally we can have the financial statements for Mawanda and Murwana prepared. Then you are going to admit it is the simplest thing you can ever do. It's not hard. So now, let us begin. First of all, part 1 tells us, the question, what is required of us is prepare the income statement, profit and loss, and the balance sheet as at that date. Yes. Quite cheap. I have it here. Okay. We are going to have Mawanda and Murwana financial statements. Okay. So this is Mwanda. We can also the Excel sheet. This is Mwanda and Mwana. Income statement. For year ended 30th June 2007. Now a year that ends 30th June must have started 1st July. So if assuming this is 2007 30th June when the year ended, it means it started 1st July 2006. Again counting, you are supposed to get 12 marks. If they are not 12, it means there is a real problem. You have not counted properly. Okay. These are shillings, hopefully in thousands. Can have shillings here in thousands, and also have shillings here. I want to imagine you have this already with you. So begin sales and the sales figure. You look for it. Normal way of doing this accounting. Just look for the sales figure, come and place it. Normal way of doing accounting. Then you say, do we have sales returns? What we call returns inwards. You look around. Check in your question paper, check your question so that you have sales returns. I am proving beyond a doubt I have nothing like a sales returns. So the sales for the year automatically become the net sales. I look for cost of sales. Cost of sales. Very simple. The cost of sales figure is got by getting opening inventory. Where is our opening inventory? The inventory is at 30th June 2006. It must be the opening inventory here. Then this is the opening inventory. Then you add purchases. Where is our purchases figure? Let us look for the purchases. Purchases. The purchases are there. You also pick the figure for purchases and put. The figure of purchases is there. So let me give this one a separate color such that it doesn't confuse you in any angle. It must get a separate color. So I've given it a separate color. It shouldn't disturb you in any way. Our number is here. Sales, cost of sales. How to get cost of sales? How to get cost. Now this one should work as a boundary. This is the question. This is should work as a boundary. I want it to remain black. Then you can still read the figures. Okay. So now do as good. This is now a boundary. It's a boundary. This is the question. This is where we have the workings. So the sales, cost of sales, you get opening inventory, you add purchases. Then you look around. Do I have carriage inwards? Carriage inwards are going to be expenses associated with transferring the inventory to the premises of the partnership where we're going to sell or to transform them into finished goods from. If you have carriage inwards, they're always added on purchases. As I'm looking around with my number, I can't see carriage inwards. Because they are not there, I should just look for purchase returns if they are there. Those are returns outwards. Because returns outwards should be subtracted from the purchases. I cannot see returns outwards. They are not there. So since returns outwards are not there, we just get the opening inventory, then we add the purchases. Returns outwards are not there. Opening inventory, add purchases, such that we get cost of goods available for sale. Just a summation of the two. Cost of goods available for sale. To summation of the two. So equals sum I10 I10 inside I10 I9 I9 to I10. So I've summed up. This is the cost of goods available for sale. Less the cost of goods available for sale. You subtract. That's the meaning of the word less the closing inventory. I'm preparing financial statements for the partners, Mawanda and Mulwana partnership. But I'm beginning with the income statement. It's what we are preparing here. And the steps are just moving on very well. Things are just moving on very well. The closing inventory, I saw it from down here. Inventory. As at the end. Closing inventory. I'm failing to see it. Closing inventory. Closing inventory. So we must have missed some things here. Very good thing I've got them. Okay. So the inventory is somewhere here. 450, 720, Okay. This is the closing inventory. That's the figure. So when you less closing inventory, you are going to get the cost of sales, because always cost of goods available for sale minus closing inventory, you get the cost of sales. Let's see, going to be I 11 minus I 12. That is the cost of sales now. Cost of sales. Now sales, subtract cost of sales, you establish gross profit. Somewhere here. So this is going to be J5 was J5, then I subtract J13. Very cheap. Is it J5? It's J7. J7. And I subtract J13. Yeah. That is the gross profit. That's the gross profit. You see? Then after getting gross profit, you ask yourself, do I have any other income? If you have other income, it is supposed to be added to gross profit. If you don't have other income, then you just move on. Other income, I mean now incomes like rent received, it may be discount received, it may be decrease in provision for bad and doubtful debts. It is also other income. So let us check around and see if we have other income, and we add it to gross profit. If we don't have other income, then there is no need of adding it to gross profit, of adding anything to gross profit. We just move direct to operating expenses. Let us check around and see whether I have. Let's check around and see whether we have other income. The partnership is for Mawanda and Moana. We are preparing an income statement. We're trying to see. I want to imagine you have the question and things are moving on very well. It's not hard, just a matter of following the steps. This format I gave you yesterday, and it is the same format I am also trying to follow. Do I have discount received? I am checking around to see. The number shows me there is no discount received. Do I have rent received? I am checking around to see whether there is rent received, and I can't see rent received. And I ask myself a question. Hey, I can see provision for bad debts in the trial balance here. You know, a provision for bad debts is now, in most cases, students confuse it with bad debts. They think bad debts and provision for bad debts are the same. Bad debts, it's money we have ascertained. Our debtors have either deliberately refused to pay or have unwillingly failed to pay. Sometimes things happen, circumstances here and there can constrain the trader and prevent him from paying, but he was willing to pay. But it remains a bad debt. That one we write it off, and it is an expense, as you can see. So as debtors behave in such a way, you are demanding 10 million, you end up collecting 8.5. You are demanding 20, you collect 19.5. You begin getting a feeling, now I'm supposed to organize myself, prepare myself in such a way I fulfill the other convention of prudence. Overestimate cost, underestimate revenue. So I will know that each and every time I'm demanding my debtors, they don't pay me 100%. So I create a provision always for those who may not pay. But they can end up paying anyway. If they pay, the better. If they don't pay, it's fine. I have organized and prepared myself. It does not get me by surprise. So if you can try to look around and see the provision for bad debts, I can see 3,200. It is the figure Mawanda and Murana decided to put up such that they expect that if debt has paid, they may not pay that money. Let us see. In most cases, you are supposed to go to additional information and see, is this figure changing or it is remaining the same this year? Because the provision for bad debts, as you can see it in the trial balance, it was set in the previous years. Now this is the year of 2007. Did they leave the provision the same? Did they increase it or they reduced it? Because you can flex the provision depending on the way debtors are behaving in that particular year. Debtors may be paying frequently and really see there may be no chances of big bad debts. Again, debtors may poorly behave. They are not paying and you foresee a very big possibility of these bad debts and you decide to increase the provision. I can see here adjusting information D. Reduce the provision for bad debt C to shillings 2,560,000. I am reducing the provision for bad debts. First of all, they want it to be 2,560,000. Let me see the old one they had set before. It is 3,200. So, establishing the difference, if you can establish the difference between 3,200 and the 2,560. Oh, let me just get it somewhere here. Whichever that I'm putting in a different color, it means I'm adjusting it. You are supposed to be aware. It's an adjustment that is going on. So I am also putting this in red to mean it is a figure I'm just putting there for the sake of adjustment. I am getting 3,200 then minus minus 2,560 because the old is 3,200. The new provision, they want me to reduce it to, the English is 2. 2 is not by. If they told you reduce it by, it means you would just consider this as a reduction percentage. But reducing it to, it means 2,560,000 is the new provision. So the question that we have in mind is, how much is the decrease? Because for us, we are interested in the decrease. It is the decrease that we are treating as additional income to add it on the gross profit. So the decrease is, if I can subtract it properly, 3,200 minus 2,560, the decrease becomes 640. So 640 in that context is other income that I want to take straight away. I want to take this to this. Then I am going to say add other income. And amongst other income, I have decrease in provision for bad debts. The decrease is this 640. So 420, 760 plus, do you have any other income? Then you check around. In the same way, you must get me right. If this was not a reduction, but if they had told me increase the provision for bad debts too, then the increase would not be other income. That increment, that only percentage of increment, I would take it under operating expenses. It would be an expense. But since it is a decrease, it is other income that I'm putting here. So I want to get the gross revenue now. from all partnership operations, which is going to be an addition to the two. I am summing up this figure of the gross profit, that is J14. So sum of J14 to summing it up to J16. There. Now I've got the gross revenue from all operations, 41,400. Then you go to operating expenses. Operating expenses. You see how things are working out? Just very simple. Let us begin picking operating expenses. In order to be systematic, I would not support a student who just picks randomly. The best way in order not to skip any would be you going to the top. You begin looking at item per item, item per item. A building is not an expense. Fixture at cost is not an expense. Provision for depreciation is not an expense in the income statement. Trade receivables is an asset. Trade payables, those are liabilities, they are not expenses. And you must also ensure these expenses are business expenses. Expense means it shouldn't be capital expenditure, it shouldn't be personal expenditure. If it's a personal expenditure like a drawing, should not come here. If it is a capital expenditure like the purchase of furniture or buildings or vehicles, we expect to meet them, or we expect to meet such in the balance sheet. But here we want expenses incurred to raise income for a partnership. So we are moving down slowly by slowly. Slowly by slowly. Cash at bank, no. Sales, no. Purchases, we considered it up there. Carriage outwards, there. This one I will accept. Carriage outwards. This is an expense. This is an expense. So say carriage outwards. This is an expense. You pick it and you move. This is an expense. Carriage outwards. Okay, agreed. Then discount allowed, it is also an expense. Discount allowed. If it was discount received, then it would be other income. I would have added it to gross profit by this discount that we are allowing to our customers. So it becomes expenditure. And you give out a discount when you are selling. So it is an expenditure that I'm incurring when I'm raising revenue for the business. Loan interest, yes, loan interest. Loan interest is expenditure because this is a loan that I'm using in partnership to raise income. This is expenditure, I accept. I am collecting all operating expenses. Moving to office expenses, here, office expenses. However, when it comes to such expenses that can be adjusted, you must also move down. I had forgotten to tell you. As you are picking these expenses, you must keep monitoring the additional information. Because we have some expenses that have adjusting information. Let us see. Like now we have office expenses. Don't we have information that is adjusting office expenses? Maybe adjusting, I'm trying to mean maybe accruing or prepaying. That's the adjusting I'm trying to mean. Do you have any adjusting information regarding office? I'm just too lucky that I remembered at the right time. Expenses to be accrued. Additional information. F. Office expenses shillings 768. So there is an accrual here. There is an accrual here. So accrued expenditure means it is an expenditure you have incurred in a financial year, but you are not in position to pay for it, and you expect to pay for it in the next financial year. For us, we say it's an expenditure that has been accrued. So the office expenditure was supposed to be 19. You can see here, but there is accrued of 768. Now I am putting this in the first column for the sake of first adjusting it. After adjusting it, then I will take it to the main column where I have all my expenses. So this is sum of H22 and the H23. Simple. So this is the summation. So office, this one was paid, then this one was accrued. Let us move down to see other expenditure. We are here from. So when you move systematically, item per item, you cannot miss out any. Other than choosing them randomly, you stand high chances of missing out some expenditures. Salaries and wages, I can also see here. Salaries and wages. I have to first ask myself, is there any additional information such that, yes, wages accrued 1,600,000. You must also consider, because all accruals are additions, never forget. This was also accrued. You should never forget that. So this is accrued. Never forget. Then salaries and wages, so far paid, as we can see in our trial balance. Salaries and wages were 151. Let's see. These things move. Okay. Are you trying to say our expenditure? It's growing. The operating expenses are moving from here. Then we have carriage, discount allowed, interest, loan, office expenses, accrued, office salaries and wages. Then some of them were accrued. Then we move to bad debts. I can see the figure is here for bad debts. Bad debts may not necessarily need adjustments. So I'm putting it to the final column, bad debts. Then provision for bad debts. Provision for bad debts will never be an operating expense unless when we are creating it for the first time. When you're creating a provision for bad debts for the first time, it has not been there. Then the whole amount created as a provision, you are going to introduce it under operating expenses. Someone is going to ask a question. How will I know we are creating it for the first time? It has not been there. In most cases, information given in this format, for example, we have a trial balance up and additional information down. You will not see provision for bad debts in the trial balance. You don't see it in the additional information. Another way is to use the intellectual brilliance. You follow the English as it is given additional information. Then it will tell you whether you are creating it for the first time or it has been there. When you're creating it for the first time, you will see. The English may be, the management decided to create a provision for, or a provision for burdens of such and such is to be created. And you can't see it up there in the trial balance. Then you know they are creating it for the first time. There, the whole amount created as a provision is going to be brought under operating expenses. But as per this question, it means Mawanda and Murwana already had this provision. It's not for the first time. If it's not for the first time, you look at either an increase or decrease. For the sake of the question, it was just a decrease and we treated it accordingly. The decrease was added to gross profit. We are moving slowly by slowly with the number. Provision for bad debts. Okay, now we move. That's loan. These ones come in the balance sheet drawings, balance sheet items. Do we have any expenditure that we have not yet considered? And it is very much important. It is supposed to be under operating expenses. Hey, you go to additional information and check. It does not mean that expenses must only be in the trial balance alone. Even additional information can have expenditure that you need to consider. I'm trying to see here. Yes, I'm very right. Depreciation. Depreciate fixtures 10% on reducing balance. Buildings 8 million. Fixtures depreciation. Yeah, now that's very fine. Depreciation. It's another expenditure. Depreciation is the systematic allocation of the depreciable value of a non-current asset over its useful life. Check out for that definition under International Accounting Standard 16, property, plant, and equipment. So you have that. Now, students, we are depreciating two non-current assets as per the number. They want us to depreciate fixtures. They also want us to depreciate buildings. But the figure for buildings is already given 8 million. So this figure, I am just taking it the way it is. Nothing to change. This is the depreciation for the buildings. Just come and put. We are depreciating buildings. And the figure is 8 million. Then we will check out for depreciation of the fixtures. Depreciating fixtures 10%, but on reducing balance method. Remember, reducing balance method is another depreciation method. Some of you people forget. In most cases, you were looking at straight line. You people, if I can tell you here, and to depreciate for me this on straight line, I'm on reducing balance. You're going to do the opposite. But let me show you how this thing works. But for details, you check out for IS16, property, plant, and equipment. It has all these depreciation methods. We also teach them under financial accounting 1, and this is 2. So you are very much conversant, because my students of accounting talk can never fail to remember such a simple concept as we teach it under financial accounting 1. Expenditure. Okay, it is 10%. 10% reducing balance method. Reducing balance method depreciation. Let me first tell you. For reducing balance method depreciation, depreciation. The reducing balance is always given by rate times net book. Rate times net book value. And the net book value of an asset, if I can still take you further, net book value is always given by the cost of the asset times accumulated depreciation. If you called it times the provision for depreciation, you are also right, because provision for depreciation also means the same like accumulated depreciation. Provision for depreciation means the same like accumulated depreciation. Now let us look at our number there. It was 10%, 10 divided by 100 times what? That's a very big question. Times what? Because if you just get the rate 10% times the cost of the fixtures, there you are applying straight line. For us, we want reducing balance. So 10% of what is the cost? The cost of the fixture is fixtures at cost. I'm checking around to see 88,000. Okay. 88,000 minus, where is accumulated depreciation? Because I'm supposed to get the net book value. Accumulated depreciation fixtures, it means the same like a provision for depreciation. 26,400. We are following this. 26,400. Okay. This is the most appropriate expression now. 10% of 88,000 minus 26. Now, 26 is the provision for depreciation. What we call accumulated depreciation. Brought down. I cannot just subject 10% to the cost of 88,000. No. I'm supposed to first reduce accumulated depreciation brought down as given to me in the question in order to get the net book value. So practically it is the net book value that I'm subjecting to 10%. So we can see how we are getting. We are getting these things. It becomes too cheap. Work it around yourself and see what you are going to get. Work it around yourself and see what you are going to get. I am getting 6160. I'm getting 6160. Are you getting the same? I'm getting 6160. Yes, finally we are getting 6160. And that is now the depreciation for, that's the depreciation for fixtures calculated as per reducing balance method. Fixtures. Ladies and gentlemen, at this particular point in time, purely I expect that all expenses are finished from one number. Because I was moving systematically, following expenditure per expenditure, so I stand high chances of exhausting each and every expenditure. Okay. This is what we do have. I'm trying to get the summation of all the expenditures incurred. Going to be equals, okay, let's get that summation. This is I-19 to I-29, somewhere there. And this is the total operating expenditure. Total expenditure. Now, total expenditure. Subtracting it from the gross revenue from operations. Then we say exactly whether we get net profit or net loss. Shall see. We're trying to work around. Okay. This is total operating expenditure. Okay. 19. Yeah. Added. Yeah, there is a figure that we did not get here. We didn't sum. Okay, that's right. Whichever that I'm taking is what we are supposed to also be taking. You must consider all expenditures. As you can see, the way I'm handling them here. Now 186,960 is our net profit. Okay. Things are moving on right. Now are you aware that under partnership, I mean under sole trade, you just stop here? Yeah, this is what you used to do. But yesterday I told you when you just stop here with the partnership, you are calling for partners to get pangers and chiru themselves, which we don't want. So the best way to handle it is to prepare what we call the appropriation account. Appropriation. The appropriation account. How do we prepare the appropriation account? Net profit. As we have got it. See there. Just pick it, bring it. Net profit is so that's the net profit as we got it. Okay. Then we are going to add interest on drawings. Interest on drawings. I think you can see. Now students make a mistake. Instead of writing interest on drawings, they write drawings. I don't want drawings here, but I just want interest charged on the drawings. That's just off. To see, did they take any drawings? Hey, I'm seeing drawings in Mawanda Tuku, Murwana Tuku. Let me see additional information. The interest on drawings is, it is even already given. So there's no need of wasting time. For Mawanda, then Murwana, interest on drawing is already given. Mawanda, the interest on drawing is in 1,440,000. 1,440,000. Then for Murwana, interest on drawings is 160. So when you add interest on drawings, you are getting the total profit for appropriation. Appropriation. So you have got the total profit for appropriation. It is the summation of the net profit plus the interest on drawings. It's going to be equals sum. We just get it very slowly. There's no need of panicking. This is too cheap. Okay. Now this is the total profit available for appropriation after adding each and every interest on drawings to the net profit finally made by the partnership. Then we go to appropriation. Appropriation. Interest on capital. I told you interest on capital is another appropriation that we are supposed to make as we reward partners for contributing more capital. Then who gets interest on capital? Mawanda gets, then Mwana also gets. Let's see. Mwana. Mawanda gets how much as interest on capital? Let us try to see. They told us it is 10%. But 10% of what? 10% of the capital contributed by each. So Mawanda contributed 280,000. The 10% of it is going to be 28,000. Very simple calculation. Then Murwana, 10% of the capital contributed by Murwana. I can see capital account balance 236,000. So the 10% is going to be 23,600. Very cheap. However, do we have any other thing to less? Yes, we are supposed to less salary. I am following the format that I gave you yesterday of an appropriation account. Do all these partners get salary? No. Who gets salary? It is Mawanda who gets 6,400,000 and not yet entered. Mawanda only. Then you're right. Mawanda is the one who gets salary. He gets 6,400,000. 6,400,000. Okay. That is 6.4. And it is not yet entered. That's what he told us. When they tell you it's not yet entered, now we have entered it anyway. So it's now entered. So sum up what we are supposed to subtract. So we are supposed to subtract from the total profit available for appropriation. We are going to subtract interest on capital and also subtract salary. We don't have any other item I can say as per number given that we are going to be subtracting. So let us look for the summation. We are going to subtract from the total profit available for appropriation. Hope we are following this. This is I-40. 46. Okay. Subtracting. We are subtracting this from the total profit available for appropriation. So these items, we are again going to be seeing them again in the current accounts as we are going to be preparing them. So this is an appropriation account and we are moving it right. Let us subtract. This balance is what we call the residual profit, or sometimes we call it balance for sharing. We are going to have it there. This is J37. So we're going to say equals J37 minus, okay. So 131,360 is now the balance for sharing. This is now what is available to share between Mawanda and Murwana. So the next step is going to be share of the balance. That's the next step, share of the balance. How do they share the balance? Yesterday I told you how they share. We are going to go to the partnership deed and see what they agreed. What they agreed is what we uphold. So I think this question provides for. Let me go and see. It may not be providing for. Mawanda and Murwana are in partnership sharing profits and losses equally. Sharing the profits and losses equally means here they are going to share equally. So the 131,360, they are going to be sharing it equally. So we just simply divide by 2 because they are two partners. So each is getting 65. Each is getting 65. Mawanda is getting 65. 680. The same applies to Murwana. So the summation of the two, because yesterday I told you you're supposed to remain with a 0. The summation of this should be giving us the same. The totality of what has been shared. Okay. This is I-50. Okay. Yeah. So if I just take a subtraction, obviously I'll remain with a 0 here. And it's what we wanted to see even yesterday. Shall get you 0 here. I wanted to see the same yesterday. Let's see a 0. So it means our partners cannot quarrel at any point in time because they have shared each and everything. You can see the appropriation account. If I can take you slowly, it started from here, the net profit. We added interest on drawings. We get a total profit. We subtracted interest on capital, we subtracted salary, of which Mawanda was the only person getting, and we are sharing now the balance. So we are getting 0. So at this particular moment, you cannot, in as much as the question tells you, prepare the income statement and the balance sheet. You cannot prepare a balance sheet if you don't have current accounts, because given what we have been recording, we can see new developments. We can see now the salary not yet entered. We can see this profit has been shared, not yet entered. We can see the interest on drawings entered nowhere. So we are supposed to prepare a current account. Why? Look at the trial balance. The trial balance shows they are using a fixed capital method of maintaining capital accounts. That's why the capital balances are just given and very intact. And as I told you, if you see capital accounts given and very intact, it means they are using fixed capital method, and a fixed capital method of maintaining capital accounts obviously calls for preparing current accounts separate. And I'm doing it right now. It is not hard. It is just very cheap, as we can have it here. Current accounts. The current accounts for Mawanda and Mulwana. So we are going to have just a simple format. Particulars. Then we have here Mawanda. Then we get Mulwana. We are going to have particulars. Then we have Mawanda. Then we have Mulwana. In a very simple way, in a very cheap way, does not call for stressing yourself a lot. No. This is something. Okay. Hope we are now together. You can see the format of our current accounts. This time that I take as I'm laying down the formats properly, you can also take it to internalize what we have so far discussed, and you appreciate its beauty. Appreciate the beauty of accounting. These are things that some of you take to be extremely hard, but in actual sense they are too cheap. Just see how I'm working them out. I am not using a lot of energy, but I'm just making work very cheap for you. You follow. Just follow and you move together. You're working something out. Yeah, that's very great. Okay, so yesterday I told you the current accounts must have opening balances that are credit, but just don't take it for granted. As we're given a number, just say, it is on the credit. I'm supposed to first go to the trial balance and see where are these balances. That is the opening balance. The balance put it down. Let us check and see. Let's check and see. Our number is here. Current accounts. Current accounts, Mawanda and Mulwana. Yeah, both of them are on the credit. Oh, they're on the credit. They're on the credit. If one is on the debit side, please, you just put it there. Don't hesitate. You just put it there. I can see. You're on the credit. Okay. If you can see it there, let us go and see for Rwanda. See on the credit. Okay. This is very manageable. No big deal at all. And I'm calling it balance. Wrote it down. This is very great. Then I told you the debit side records what is going to reduce the claims of the partner in a partnership, and the credit records what's going to increase. So I've recorded already the balance brought down, so they put there for each. So let me just go to credit to the debit and finish it first. I'm writing drawings because drawings, I'm debiting them because they reduce. Each and every time a partner takes drawings from the partnership, it reduces the claims of such a partner from the partnership. That's why you are seeing me debiting drawings. Where are the drawings? Hey, I'm supposed to. Where are the drawings? I can't see them. Okay. Okay, they are there. They are there. The drawings are there. Yes, seen. For Rwanda and for Rwanda. Okay. Then you debit them. Okay. Then interest on drawings. On drawings. Okay. Who takes what? I don't know. Interest on drawings. Then this one, we are going to pick it from the appropriation account. Yes, interest on drawings. Who brought what? Okay. And I'm debiting just because it is the partner supposed to bring interest on drawings to the partnership. So it is the partnership demanding a partner the interest on the drawings. So if it was loss shared, I would also have it on the debit side. But unfortunately, we share the profit, we do not share losses. So let us move to the credit and see what we're going to put. I told you what we put on the credit side is the claims of the partner now from the partnership. What belongs to the partner, it is now the partnership to give to the partner. So I cannot forget here interest on capital. I told you are going to pick these things from the appropriation account mostly. Then let us see interest on capital. What did we have? Yes. I'm seeing the figures here for Rwanda and Rwanda, and I'm trying to place them properly. This is interest on capital. I'm trying to see this interest on capital. Then let us check for the salary. Who gets salary? It's again another item that I can see here. It is Rwanda who gets salary. Let us also credit it. Salary. It's Rwanda who gets salary. Of 6,400. Okay. Then we look at, I am just following the appropriation account to see how I place these things. The share of the balance, that's the share of profit. Each got 6.5, 680. Okay. We'll also put them there. That is share of profit. Of profit. Okay. I can't see any other item which I included in the appropriation account that I can bring to current account. They are all done. It's now a matter of just balancing of my current accounts. Then I move to the balance sheet. Just balancing my current accounts. Then I move to the balance sheet. Balancing them in the simplest way. Then I move to the balance sheet here. Okay. You can see the current accounts now for Mawanda and Mulwana. We are generating from the number, and I know you have them. We are following these things in a very good way. Which side is greater? Normal balancing of accounts. It looks like the debit side, the credit is greater. Yeah, credit is greater for all. So, just take a summation. Yeah. Just taking a summation. I-58. 9. Okay. This is great. Huh? Okay. So, balancing off. This is balance carried down. We can have it simply here. Balancing of these accounts. The debit or the bigger figure is written on both sides as I'm trying to work it out here. Now I'm establishing the balance carried down. It's going to be now, this is F62. Okay. 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 This is the balance carried down. For Mawanda, it is 57,888. For Mulwana, it is 45,504. Now, This is the balance carried down. At this particular moment in time, my students can easily follow the format that I gave them yesterday for the balance sheet to prepare the balance sheet themselves. However, as you're preparing the balance sheet and you reach a section of capital accounts, you pick them from the trial balance. Current accounts, don't take the balances in the trial balance. These new ones that we have just established are the current account balances that you're supposed to put in our balance sheet. Then the accruals, as we made them in the income statement, they are going to be current liabilities in the balance sheet. And the balance sheet is going to come out properly. It is the assignment that I'm leaving with you today. Just prepare for me a balance sheet for Mawanda and Murwana and send it to my email. Otherwise, the lecture for today has stopped here. Tomorrow when I meet you, I'll take you through the part 2 of the topic that is going to be changes. When changes occur, when changes happen in the partnership, what do we do? Changes, I mean admitting a new partner, a partner dying or retiring, and maybe dissolution or closing the partnership. It may also be a change that brings the partnership to an end. That's what we are going to be seeing tomorrow, inshallah. But today, the lecture has stopped here. I want to thank you so much for being so much attentive and having followed me from the beginning up to the end. Otherwise, for today, I want to say bye-bye, unless when you have questions, you can raise them before I can close the session. Any questions? Okay, if no questions, please, we can meet tomorrow, inshallah. Same time, but this time, tomorrow, please please try to attend a little early and we don't begin late, because I intend to finish the remaining part of partnership. And maybe Thursday or another day, we begin single entry and incomplete records. Thank you very much.